Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
And we've got a seriously heavy docket for this deep dive today. If you're sitting on a risk committee or working in retail strategy, compliance, or legal DAL, you really need to be paying attention this week.
Yeah, it's been one of those weeks where the headlines aren't just busy, they are structurally significant.
Exactly. We've got inflation numbers that look like a victory lap, but are actually a massive bear trap for credit models. We've got the regulator taking a red pen to EU securitization rules, and an eye-watering fraud case.
But we have to start with a story that has effectively frozen every conversation in the city this week. The arrest of Andrew Mountbatten-Windsor.
It is the absolute cold open of the year. Arrested on suspicion of sharing confidential government briefings with Jeffrey Epstein.
Yeah.
Now, obviously, we aren't a gossip column. We don't do royal watching. But we do look at governance, and this screams governance failure.
It does. Completely. Because if you strip away the titles, the palace intrigue, and the scandal, what you're really looking at is a failure of controls that should look very, very familiar to anyone who remembers the Jess Staley and Barclays saga.
Right, the recurring theme.
Exactly. It's the recurring theme of this entire briefing today. The VIP exception.
The idea that when someone is important enough or claims to be important enough, the normal rules of engagement just evaporate.
Spot on. When high-status individuals get a pass on scrutiny, things go catastrophically wrong. Whether it's a royal, a bank CEO, or a billionaire client. The moment you let prestige substitute for process, you are introducing a fatal fault line into your organization.
Which sets up our master narrative perfectly. Today, we're going to look at several cracks that have just turned into absolute chasms because of that exact dynamic.
Yeah, we're covering that Mexican billionaire who lost $400 million in a perfect fraud.
We're breaking down the FCA's fine of the former Carillion CEO for signing off on what was effectively fiction. We're looking at the UK's inflation paradox, why 3% isn't the party everyone thinks it is.
Plus, the PRA's overhaul of securitization. And the slightly dystopian case of Lloyd's using its own staff's bank accounts as a pay negotiation weapon.
It's a busy one. Let's get right into it. Unpack this VIP exception for us with a story that reads like a spy novel, but it's actually a terrifying case study for AML teams.
The crypto billionaire.
Right. A Mexican crypto-loving billionaire has lost approximately $400 million.
To a fraudster posing as a European aristocrat.
You literally couldn't make this up. How does a billionaire who presumably has a family office, a phalanx of lawyers, top-tier bankers, lose nearly $500 million to a guy with fake aristocratic credentials?
Well, that's the thing. It wasn't a tech hack. They didn't crack his password or steal his private keys. It was a prestige hack. The fraudster created this incredibly elaborate persona. Elite banking connections, old European money, the right accent, the right bespoke suits.
And a complete failure of basic KYC and AML controls.
Exactly. The failure here was in the assumption chain. The lawyers assumed the bankers had done the know your customer checks. The bankers assumed the family office had done the due diligence.
And the family office assumed, well, this guy knows everyone. He must be legitimate.
It's the bystander effect, but applied to compliance. Nobody'd actually checked the counterparty. It's prestige substituting for process. This fraudster used bespoke cross-border structures and relationship-driven deals to basically bypass standard checks.
Because nobody wanted to kill the vibe.
Precisely. Because it was framed as a high-level VIP transaction, nobody wanted to be the junior compliance officer asking the aristocrat for a utility bill or a passport photocopy.
And that links directly back to the Andrew Mountbatten headline and the Jess Staley precedent. Status becomes a get-out-of-controls-free card.
It's the identical pattern. Barclays paid the price for years of deference to a powerful figure. The internal controls at the bank struggle to challenge the CEO's relationship with a high-status individual.
And here you have a billionaire bypassing checks because of the aristocratic status of the counterparty.
The regulatory reality here, and the lesson for every retail bank listening, is simple. The FCA and the PRA do not accept, but he was important as a defense. They absolutely do not care if the client plays golf with your CEO.
Which leads to my hot take for the week. If your compliance controls apply differently depending on whether the client plays golf with the CEO, your controls are broken.
Broken and effectively useless. VIPs should actually have more scrutiny, not less, because the numbers are bigger and the structures are far more opaque.
Speaking of opaque structures and people at the top getting a pass, let's talk about Carillion. The FCA has finally issued a final notice for Richard Howson,
The former CEO. Fined £237,700.
And it would have been nearly $400,000 if he hadn't received a discount for cooperation. The charge is being knowingly concerned in misleading market announcements. But here's the thing that stands out to me. He wasn't the finance director. He was the CEO.
Yeah.
Usually, CEOs can hide behind the "I relied on my finance team" defense. How does a CEO get pinned for this?
It comes down to the recklessness standard. The FCA found that Howson was signing off on announcements saying the company was meeting expectations while he was literally sitting on internal data showing massive catastrophic losses. You cannot tell the market everything is fine when you have a report on your desk saying you are bleeding cash.
Let's look at the specific numbers, because the gap between the public statements and the internal data was staggering. The FCA highlighted the Royal Liverpool University Hospital project, the RLUH.
That's the smoking gun in this notice.
Right. So publicly, the market was told to expect a £13.6 million profit on that hospital project, but internally, the team assessed a loss of between £39 million and £62.6 million. It's unbelievable.
That is a delta of over £35 million on a single project, and it only grew to $72 million from there. How do you hide a £70 million hole?
Through what the investigation revealed as the audit-friendly lie.
Audit-friendly?
Yeah. It's a euphemism for a fictional narrative. They had audit-friendly position papers, and then they had clean internal papers. Staff were actively pressured to hold the position.
Meaning maintain the profit margin in the accounts at all costs.
Exactly. Using aggressive accounting judgments and negative accruals to hide what they called hard risks. Money they knew they were never going to recover. They were scrubbing these hard risks out of the papers shown to the auditors while keeping a secret set of clean papers for themselves that showed the actual disaster.
For our listeners in retail banking who obviously aren't running construction firms, what is the takeaway here? The takeaway is about management adjustments. If you are in a bank and you are holding a position based on optimism rather than data, if you hear phrases like, "we need to hold the position," or "we'll make it back in Q4, that is a primary conduct risk. Optimism is not an accounting strategy.
Treat any instruction to hold a position in financial reporting as a massive red flag.
Absolutely.
If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
Let's pivot to the macro picture, the inflation paradox.
Right. Let's run through the ONS figures for January 2026. Headline CPI is down to 3.0%. That is the lowest we've seen since March 2025.
Sounds great on paper.
It does. But then you look at unemployment, up to 5.2%, which is the highest since 2015 if you exclude the pandemic anomaly. And wage growth is slowing down to 4.2%.
This is why it's a paradox. And it's a critical reality check for anyone managing risk right now. Disinflation is not deflation.
Prices are still rising.
Exactly. 3% inflation means prices are still going up, just at a slightly slower rate than the peak of the crisis. But they are going up on top of the massive hikes we've already endured over the last 3 years. Those costs are baked in.
The data shows food prices are still up 3.6% year on year, and services inflation is incredibly sticky at 4.4%.
That sticky services figure is exactly why the Bank of England has very limited room to cut rates aggressively. So here is the direct warning for retail credit risk teams. Do not mistake a lower headline inflation rate for recovered customer affordability.
Because the consumer is still paying baked-in high prices, but now they are facing a 5.2% unemployment risk.
Precisely. Disposable incomes remain completely suppressed. The cost of living squeeze hasn't vanished. It has just morphed from a pure price shock into an income and employment shock. If your credit models are relaxing because the headline CPI starts with a 3, you're flying blind. Watch the unemployment correlation.
Don't relax your credit models on the basis of headline numbers. Great advice. Now let's talk about the regulatory plumbing. The PRA is overhauling securitization rules. Consultation paper 226.
Yes, and this is actually about simplifying things. The PRA is removing some of the highly prescriptive due diligence templates that were inherited from the EU.
Because currently, those templates account for up to 30% of investor startup costs, which is a huge barrier to entry.
Massive. It's dead weight. So they are bringing in some pragmatic changes, introducing L-shaped risk retention, which allows firms to combine vertical and first loss retention. It gives structuring teams way more flexibility.
They are also exempting single loan retail securitizations from the complex reporting, things like the mortgage guarantee scheme.
Which is just common sense. You don't need a complex derivative template for a government-backed retail mortgage. Ultimately, this is about lowering barriers to entry and actively diverging from EU red tape to boost UK competitiveness.
Keeping with the plumbing, UK banks are scoping a new domestic payments rail, Delivery Co.
The sovereign payments rail.
Right. We have the bosses of Barclays, NatWest, Lloyds, all meeting to design a domestic alternative to Visa and MasterCard, because currently those two process 95% of UK card transactions.
Which is a huge single point of failure.
Exactly. The motivation is resilience and sovereignty. There are fears of Trump risk or the U.S. weaponizing payment rails. But Jamie, there is a massive twist here.
There is. Both Visa and MasterCard have been invited to co-fund and co-design it.
Which feels like inviting the fox to co-design the henhouse. If the point is to escape the American duopoly, why invite them to build the escape route?
Because it proves this isn't a commercial revolution. It is purely a resilience hedge. It's a backup pipe. If the UK actually wanted to displace the incumbents by 2030, they'd be building a system with full consumer protections. Section 75, chargebacks, all of it. Without that, it won't replace everyday spending. It's just a sovereign safety net funded by the people it's supposed to protect us from.
A very expensive insurance policy. Now let's look at conduct and culture. We have three stories that really highlight the ethical tightrope banks are walking with data and AI, starting with Lloyds Banking Group.
This one is raising eyebrows everywhere. Lloyds is under ICO scrutiny for using the anonymized current account data of 30,000 of their own employees.
During union pay negotiations.
Yes.
Yeah.
The bank essentially argued that the data showed their lower-paid staff were more financially resilient than the general public.
So they looked at their employees' bank statements to justify not paying them more.
That is the allegation. It is a massive GDPR purpose limitation risk. You collect that data to run a banking service, not to use information asymmetry against your own workforce in a wage dispute. It's an incredibly bad ethical look.
And it sets a dangerous precedent. Speaking of bad looks, let's head over to KPMG Australia.
Senior partner fined 10,000 Australian dollars.
For using generative AI to cheat on a mandatory training assessment, and the topic of that assessment.
The ethical use of AI.
The irony is just off the charts. A senior partner cheating on an AI ethics test using AI.
It's hilarious, but it points to a real cultural issue. If senior partners are treating compliance training with that level of contempt, what message does that send to the junior ranks?
Well, maybe they're taking cues from Accenture. Because there are reports coming out of Accenture that they are actively tracking employee logins to internal AI tools to measure reskilling.
Which creates a surveillance culture. Tracking logins creates a culture of fear around adoption. Employees will just game the metric. They'll log in, leave the tab open, and learn nothing. Surveillance does not equal reskilling.
So, bringing this all together, we've covered a huge amount of ground today. What is the master narrative tying this docket together?
It is the gap between appearance and reality. The most dangerous risks in retail banking right now are the ones dressed up to look comfortable.
Like the aristocrat who was actually a fraudster.
Exactly. Or the CEO's market announcements claiming they're meeting expectations while hiding $60 million in hard risks.
Or an inflation headline of 3% that completely masks the persistent cost of living squeeze and rising unemployment.
And even the sovereign payment rail that appears independent, but is quietly funded by the foreign incumbents.
Appearance versus reality. So give us the actionable takeaways for the professionals listening. What's the checklist?
4 points. First, apply your controls regardless of client status. No VIP exceptions. Second, treat any instruction to hold a position in financial reporting as a primary conduct risk trigger. Third, do not mistake disinflation for deflation in your credit risk models. Watch that unemployment correlation.
And fourth,
monitor the ICO's decision on the Lloyds investigation carefully, because whatever they decide will set a precedent for UK GDPR purpose limitation that affects every single retail bank holding staff accounts.
Brilliant. And before we wrap, you had a final provocation for the listener on that Delivery Co. project.
I do. Think about this as you head into the office. If the UK builds a sovereign payment system to protect its economic independence, but invites the very duopoly it fears to design and fund it, have we actually built resilience? Or just a very expensive illusion of control?
That's all from us this week. Thanks for listening to Red Talk UK. Until next time, stay sharp and stay.